Seen joining us now on the markets, Ellen Hazen, Chief Market Strategist, Portfolio Manager at FL Putnam Investment Management. Ellen, you said you perceived some of Chair Powell's comments as being a little more dovish. So I guess what you mean by that is that he said maybe the pause will go on. But at the same time, he always gives something for both sides. He said, are we restrictive right now? If you look at the economy, I don't think so. So which is a more important statement from him?
Great question. And he is very careful in how he communicates with Wall Street. I would say that because he presented the risks as more balanced between the risk of choking off higher growth and the risk of higher inflation, that he is a little bit more dovish. I think that in prior speeches, he has left the door open for a November hike. And I think there was pretty broad consensus agreement yesterday that that's off the table now, but he is leaving December open. And I think the big question is what he pointed to in his comments, which is whether or not the higher 10-year real yield is sufficiently restrictive that it will help do some of the Fed's job for it, so that it needs to do maybe a little bit less at the short end. And I think the jury's still out on that. He said as much, and I think it's also true among market participants that they don't know whether or not the 10-year is doing the Fed's work for it.
Well, we actually were talking about that earlier. Be careful what you wish for. I mean, the 10-year, if it really is untethered and it continues to go higher, it could end up doing more than what the Fed really wants it to do. It could slow the economy down more than what it would look like a soft landing.
That's the risk, right? He has always said that it works with long and variable lags. We don't know the magnitude that it's working, and we don't know the lags. We do know that the U.S. consumer is much less sensitive to interest rate increases than it used to be, according to past playbooks. So everyone or many people refinance their mortgages at lower rates. So that is relatively less sensitive. People have a lot of excess savings. Although that has been worked down, there's still excess savings. And so that means that people need to borrow a little bit less too. And so the economy is less sensitive. The consumer is less sensitive to higher rates than it used to be. And so the question is, does that mean that they need to do more in order to achieve the same outcome? Or does it just mean that it's going to be elongated? And I don't think they know. And that's why they are looking to remain stable for now, but keep the door open for further increases.
What's all that mean for the stock market? And the VIX is suddenly above 20. Just give me about a minute worth of what you think in terms of whether this is a time to enter, hold, exit. What do you think?
I think the key question that investors are facing right now, Joe, is whether or not the fact that large cap growth stocks have outperformed everything else, not only year to date, but since May, right? Since the broadening that we saw in April and May really changed, and whether or not that is going to come back or not. Why has that happened, right? And so one narrative is, has the broadening ceased because people in aggregate sense a recession coming, and therefore they're flocking to high quality? Or is it simply performance chasing, right? And I think the way we're going to determine that is by looking at the relative earnings growth and outlooks for the small and mid cap and value stocks versus the large cap as the rest of earnings unfolds over the next week or two.